Okay, so picture a mathematical crosshair. And right in the absolute center of that crosshair is a crypto whale who has just opened this massive, $39 million Bitcoin short position.
Oh, wow. That is a heady position.
Right. And according to the live data, their liquidation price, that mathematical point where the exchange forcefully closes the trade and they just lose all their margin, it's sitting at exactly $88,448.
That is painfully specific.
Yeah, so the billion-dollar question hanging over the order books right now is, well, will the market makers engineer a squeeze to hunt that specific whale down?
To really understand the gravity of that scenario, we have to look at the actual mechanics of a short squeeze. When you short Bitcoin, you're basically borrowing an asset to sell it, hoping to buy it back lower.
But if the price goes up instead?
Exactly. If it goes up and hits that $88,000 mark, the exchange doesn't exactly ask politely for the money back. They trigger an automated forced market buy to cover your debt.
Which means a forced buy of $39 million instantly hits the market.
Right, which drives the price up even higher, and that triggers the next short seller's liquidation price, and then the next. It creates this violent cascading domino effect. We're looking at a highly combustible zone of systemic leverage right now.
Which perfectly brings us to our mission for this deep dive. Today, we are taking an exclusive look over the shoulder of Simon, who is a master trader from the Paradise team at MyCryptoParadise.
And his analytical notes are just fascinating to break down.
They really are. We're using their internal framework as a case study to unpack the ultimate difference between a gambler's mentality and a professional trader's mindset. And we're going to use the current chaos in the Bitcoin market as our psychological testing ground.
I think setting the tone here is critical. In a market that's fundamentally fueled by panic and hype and just endless social media noise, the MyCryptoParadise philosophy is really about being a beacon of discipline.
It's all about leaving those emotions at the door, right?
Right, exactly. For you listening right now, consider this an invitation to step inside this inner circle of trust. This is where data rules and impulsive reactions are just systematically filtered out.
So let's start with the technical reality they are tracking right now, because the setup is pretty tense. Bitcoin is currently slamming into a major resistance wall at $78,700.
Yep, the 786 Fibonacci level.
Right. And for anyone wondering why a specific mathematical sequence matters, it's not because of, charting mysticism. It matters because algorithmic trading bots are hard-coded to execute massive sell orders at that specific ratio.
They absolutely are. It's programmed resistance.
But the really crucial detail Simon highlights in his notes is that Bitcoin is trying to reclaim a critical moving average trend line on the weekly time frame for the third time.
And that's where people get caught. The assumption that a level breaks just because it gets tested multiple times is a huge trap. When we look at the historical data mapping from the Paradise team, there's a direct parallel to 2018 and 2022.
Oh, those are brutal years.
Yeah, they were. During those cycles, the last time Bitcoin aggressively tested this same weekly moving average and failed, it printed what we call a shooting star pattern.
Let me actually try to visualize that for you guys. A shooting star pattern happens when the price spikes massively during the week, making retail buyers think, oh, the breakout is confirmed.
Yeah, the classic fake out.
Right, but before the week closes, the sell-side pressure just absorbs all that momentum and pushes the price all the way back down. So it leaves this long upper wick on the chart. It basically looks like a visual footprint of buyers just getting completely trapped.
That's a great way to put it. It's a footprint of structural exhaustion. The buy-side liquidity just dries up. And what the historical data shows is that following that specific pattern in 2018 and 2022, the market suffered a brutal 38% drop.
38%, just gone.
Gone. When you study the start of genuine, sustainable bull runs, they don't originate from these hesitant, multi-attempt struggles where the trading volume is steadily declining.
So what does a real one look like?
A legitimate bull run requires a massive influx of new capital. It manifests as one confident, high-volume weekly candle decisively breaking the resistance. But right now, we're seeing the exact opposite. We're seeing declining volume at resistance.
Wait, okay. If the historical footprint from 2018 and 2022 is this perfectly documented, right? And the data clearly shows these fake-outs precede massive drops, why do millions of people buy into the exact same trap every single cycle?
Well, the answer isn't actually on the candlestick chart.
No.
No, it requires looking at human behavioral psychology. When we examine why retail traders are statistically likely to lose their capital over the long term, we have to admit that the human brain is biologically ill-equipped for probability-based trading.
I feel like it's like a horror movie where the audience is screaming at the character not to go into the dark basement, but they just grab a flashlight and do it anyway.
That is exactly what it is.
Yeah.
The primary driver of loss, even if someone catches a lucky short-term trade, is that primal biological urge to catch the exact bottom or sell the exact top.
Yeah, the MyCryptoParadise analysis refers to this as the retail mirage. And they map out this really painful reality. You have an everyday trader, right? Maybe they have a $5,000 account.
Which is a decent starting size.
It is. But instead of utilizing proper risk management, they deploy 20x, 30x, or even 50x leverage because they're chasing life-changing wealth in a single cycle.
And that's driven by pure FOMO, fear of missing out.
Exactly. They see a minor price dip, their heart rate spikes, and they convince themselves, oh my God, I'm missing the absolute bottom. So they just throw highly leveraged capital at the screen. If you're listening to this and you've ever felt that sudden pit in your stomach when a green candle shoots up and you aren't in the trade, that is the exact biological response we're talking about.
And the sinister part is how that biological response is weaponized against you.
Oh, by the market makers.
Yes.
Yeah.
The large-scale institutional players understand that neurochemistry way better than retail traders do. They don't just sit around waiting for FOMO to happen. They actively engineer it through order book manipulation.
How so? Like, what are they actually doing?
Well, they'll place massive spoof orders, basically fake walls of buy pressure, just below the current price.
Yeah.
It creates this false sense of momentum and safety.
So retail traders see the order book lighting up, assume institutional money is stepping in to buy, and they jump in with high leverage.
Exactly.
It sounds like amateur traders are playing the lottery, just desperately trying to pick the winning numbers, while the professionals at MyCryptoParadise are basically the casino. They just rely on pure cold probabilities.
That's a perfect analogy. The market makers control the music in this high-stakes game of musical chairs. They create the illusion that there are plenty of chairs available, they wait for retail to leverage up, and then in a millisecond, they pull their spoof orders.
They cancel the liquidity.
Right, they cancel it and trigger a massive price crash. The retail leverage just determines how hard those traders hit the floor when the music stops.
Yeah.
The short-term emotional trader isn't actually a participant in the market.
They're the product.
They're the exit liquidity for the professionals.
Ouch. So if acting on FOMO and guessing the bottom makes you a gambler, what does the professional MyCryptoParadise strategy actually look like? Because Simon outlines a system where capital protection supersedes literally everything else.
Yeah, and capital protection isn't just a corporate buzzword for them. It is a strict operational mandate. The framework we're analyzing operates on the principle that a professional trader would willingly miss an entire market bottom or even sit out a market top rather than expose their capital to low probability conditions.
So the goal isn't to be a psychic.
Not at all. The goal is to protect your wealth.
Okay, so if we remove prediction from the equation entirely, what are they actually looking for? The notes mention waiting for confirmations.
Right. Confirmations are everything. A professional doesn't guess when a resistance wall will break. They wait for a breakout to happen, but it has to be accompanied by rising volume.
Because retail traders alone can't generate those massive volume spikes, right?
Exactly. Rising volume proves that institutional capital is driving the move. But here's the kicker. Even then, the Paradise team doesn't buy that initial breakout.
Wait, really? Even with institutional volume?
Nope. They wait for the retest. The absolute highest probability entry occurs when the price returns to test that newly broken resistance line. But it has to do so on declining volume.
Ah, so declining volume on a downward move means the sellers are just exhausted.
Precisely. They have no more capital to push the price lower. Waiting for that transforms a blind guess into a verifiable sequence of events. And currently, the lack of those volume confirmations is exactly why Simon's analysis isolates a classic head and shoulders distribution pattern on the 4-hour time frame.
Okay, let's break down the mechanics of a head and shoulders pattern because it's way more than just a shape on a chart. Visually, you have an initial peak, which is the left shoulder. Then the price pushes higher to form the head, drops, and forms a lower peak, the right shoulder. But what's actually happening beneath the surface?
It's basically a phase of asset distribution. During that left shoulder, you have the initial hype and early accumulation.
Okay.
But the head that represents the maximum retail trap, this is where FOMO is at its absolute peak. And it is the exact moment market makers begin quietly offloading their heavy bags onto retail buyers.
Wow. So by the time the right shoulder forms.
The smart money has already exited. It's just a final, weak, upward push before structural failure. If the price breaks the foundational support of this pattern, what we call the neckline, the lack of buy-side liquidity means the next major structural support doesn't exist until down around $71,000.
And the on-chain data makes that downward pressure look even heavier right now. I mean, the MyCryptoParadise analysis tracked this massive cluster of sell walls sitting right below the $80,000 mark.
Yeah, that data point was staggering.
Right, exactly. 474 Bitcoins are just waiting to swat the price down. Tens of millions of dollars acting as a physical barricade.
And that barricade is exactly why true market bottoms are almost never formed by a sudden burst of retail enthusiasm. Real structural bottoms require complete capitulation.
You know, when you say capitulation, my mind automatically goes to, like, a retail trader finally rage quitting, closing their laptop, and just deleting their exchange app. But you're talking about something deeper, right?
Yeah, the retail trader giving up is just a symptom. The structural cause actually involves the Bitcoin miners themselves.
Oh, the people securing the network.
Right. Miners operate these massive warehouses of ASIC computers, which require immense amounts of electricity. They earn Bitcoin, but their operational costs, their electric bills, are paid in fiat currency, like dollars.
Okay, that makes sense.
So in 2018 and 2022, the true bottom of the market was only established when the price of Bitcoin dropped so low that the revenue from mining didn't even cover the electricity costs anymore.
Wait, so they were operating at a daily loss?
A massive daily loss. Eventually, they are forced to capitulate. They have to aggressively sell off their reserve Bitcoin holdings just to keep the lights on and pay their debts.
So that forced mass liquidation from the producers themselves is what creates the ultimate market flush. It wipes out the order books entirely.
That is the true exchange of hands. And Simon's analysis suggests that based on current network hash rates and energy costs, that actual capitulation zone might realistically be waiting all the way down in the $55,000 to $44,000 range.
Wait, just pause for a second. Asking a trader to sit on their hands while the price bleeds out from 78,000 down to 44,000, that defies basic human instinct.
It absolutely does.
I mean, every social media algorithm is designed to push content screaming that the breakout is happening today. How does a human being actually execute that level of patience without their biological instincts just overriding their logic and causing them to panic buy?
It is arguably the hardest aspect of trading, because willpower alone is a depleting resource. If you rely solely on sheer willpower to resist FOMO, you will eventually break.
You just get worn down.
Exactly. The friction between what the data dictates and what your neurological survival instincts are screaming at you to do is immense. And this is where the MyCryptoParadise methodology becomes a truly fascinating study in psychological engineering. They realized you have to artificially anchor the mind.
Yes, this was the most unexpected detail in the source material for me. They didn't just write down some trading rules in a PDF. They actually released a professional trader album on Apple Music.
Yeah, it's brilliant.
An entire album designed specifically for their traders. There's even a track titled Like a Sniper. I mean, it sounds like a gimmick at first, but the reasoning is deep.
Well, while it might sound unconventional to outsiders, the neurobiological reasoning behind it is incredibly sound. The financial markets are literally optimized to present you with highly emotional triggers all day long. Watching your portfolio value plummet or seeing a massive red candle form triggers your amygdala.
And that's the part of the brain responsible for the fight or flight response, right?
Yes. Your brain processes that flashing red screen the exact same way it would process a physical threat in the wild. It floods your system with cortisol.
And when you're flooded with stress hormones, your prefrontal cortex, which is the logical probability calculating center of your brain, basically just shuts down.
It goes offline entirely. And you cannot execute a probability-based trading system when your prefrontal cortex is compromised. So music is utilized here as a psychological tool because it operates on an entirely different neural pathway.
So it bypasses the panic.
Exactly. It has the capacity to bypass the conscious panic response and directly calm down the autonomic nervous system. The album serves as an engineered environmental control, helping the Paradise team stay calm, confident, and disciplined amidst all the chaos.
It's about engineering your environment so that discipline becomes the default state rather than this constant, exhausting struggle. And that concept perfectly anchors the professional mantra that Simon outlined in his notes.
I love that mantra.
I want to share this directly with you listening because it just beautifully encapsulates the shift from a gambler to a professional. The mantra is, probabilities, not emotions. I remain calm and disciplined in every market condition. I follow my trading system with precision and patience, waiting only for high probability setups. I respect risk management and protect my capital above all else. Losses are feedback. I sharpen my strategy, and wins are the result of disciplined execution.
What really stands out in that framework is the complete removal of ego. Losses are not personal failures anymore. They are just data points used to refine the system.
It changes everything. It shows how having a team like MyCryptoParadise in your corner changes the solitary, anxiety-inducing experience of crypto into a really supported, professional journey.
It shifts the entire dynamic from hoping for a lucky break to executing a repeatable process.
So let's synthesize all of this and look at the landscape we've mapped out today. We started with a $39 million whale in the crosshairs, waiting to see if a liquidation cascade would trigger. We broke down the painful behavioral biases that market makers exploit to trap retail FOMO.
We looked at the deep structural economics of minor capitulation.
Right, and finally, we unpacked the psychological engineering required to actually survive the wait and trade like the Paradise team.
You know, if we extract the core lesson from all of this data, it turns the spotlight entirely onto you, the listener.
Yeah.
The mechanics of FOMO and probability extend way beyond Bitcoin charts. Think about the major financial decisions you're currently navigating, or even just your broader life choices. When you are faced with high-stakes uncertainty, how are you reacting?
Are you desperately trying to catch the exact bottom?
Exactly. Are you making decisions driven by a fear of missing out, jumping at the first sign of movement because you're terrified of being left behind? Or are you willing to sit back, protect your energy, and patiently wait for the ultimate confirmation before you execute your move?
Wow. It fundamentally reframes how we perceive risk. The market and life in general will perpetually create situations designed to trigger your panic response.
It will, and the opportunities will always present themselves again. The only variable is whether you have retained the capital and the clarity required to actually capitalize on them when they finally arrive.
That is such a powerful thought to leave on. Thank you for joining us on this deep dive into the underlying mechanics of the market. Stay disciplined, trust the probabilities, and we'll see you next time.